Okay, I thought I'd just record a very quick video explaining why I trade the E-mini. I'm going to do this video in two parts. The first one is choosing the right market, and then the second part is choosing the right vehicle. In terms of markets, you've got really five major choices out there for a trader. You can either trade stocks, Forex, commodities, bonds, or stock market indices. And then there are a number of vehicles that you can trade each of those markets with. So for example, futures, the mini futures like the E-mini, the Dow mini and so on. You've got exchange traded funds, ETFs, things like the SPY and the Cubes, the QQQQ for the NASDAQ. Then you've got options, contracts for difference, and warrants. In this video I'm really just going to be dealing with these major markets, the five major markets, and what the pros and cons of trading each of those markets are. Now ultimately I do realize that the market that you choose to trade is a very personal decision, so I'm not aiming here to change your mind if you're a stock trader or a Forex trader, but just maybe give you an alternative perspective on some of the advantages of the E-mini. Because ultimately what you want to be doing is giving yourself the best chance possible, and I think there are some markets that have good opportunities that are better than other markets. Now my answer is obviously going to be the E-mini. I run a site, Emini-Watch. If you're watching this on YouTube, you're watching it on the Emini-Watch channel, so there's no kind of surprise there, but a little bit of a twist at the end, and I'll show you that on the very last slide that I have. And then in terms of experience, I've pretty much traded everything there is out there. I've been trading for about 16 years now. I started trading stocks, moved on to options, then on to commodities, and I've traded Forex and bonds as well. So finally arrived on E-minis probably about 6 years ago. So I've got a wide experience in terms of the different markets to trade. So I'll try and give you some of the insights that I've gleaned over the years. Now here are the five markets that you can trade: stocks, Forex, commodities, bonds, and stock indices. And I'm going to put this in terms of three kind of criteria that you need to consider when assessing the pros and cons of each of these markets. First of all, you want to minimize the number of decisions that you make. The more decisions that you have, the more opportunity you have to make a bad decision. So you need to minimize decisions. Then you also need the maximum amount of information. In order to make a good decision, you need maximum information. And then lastly, there are different kinds of volatility out there. There's good and bad volatility, there's erratic volatility, there's no volatility, and each of the markets has a different characteristic, if you like, and they've got different types of volatility that make them better markets for day trading, swing trading, or investing. So let's get straight into it. First of all, the first market I want to cover off is stocks. And there's a couple of reasons why I've given stocks a bad rating here. The first one is the number of decisions that you have to make. First of all, there are thousands of stocks out there that you can pick. And ultimately, the performance of a particular stock is very largely determined by the direction of the stock market and the industry group that it's in. And there's a couple of studies that have been done over the years that tried to estimate, to quantify the impact of those factors. And one is by Benjamin King, the other one is by Dr. Robert Hagen, and those two studies kind of came up with very similar conclusions, that about 50% of a stock's directional move is driven by the direction of the stock market itself. Then another 30% of a stock's move is driven by the industry sector that stock is in, and ultimately only about 20% of a stock's move is being driven by the individual stock itself. So if you're going to have to decide the direction of the stock market and the industry sector and the stock to be chosen, all of a sudden you've got a large number of decisions there, and you need to be minimizing those because you can be making mistakes along the way. There's a great deal of information in the stock market and on individual stocks. Do all kinds of research, so there's plenty of information out there. But lastly, in terms of volatility, you get stocks that can be doing nothing during the day, or they can do all of their move in the first 15 minutes of the day, and you can spend the rest of the day, if you're a day trader, kind of sitting on your hands and doing nothing. So that's my reason for nixing stocks. Then next market is Forex. Now in terms of decisions, fewer decisions in terms of Forex. There are ultimately about 55 different kind of Forex pairs that you can trade out there, but there are 5 major pairs that are traded. You could also reduce the number of decisions you have in terms of what market to choose by just trading the DXY, the dollar index, which trades against a basket of different currencies. So not too many disadvantages there in terms of number of decisions. There's also quite a lot of volatility in the Forex market. The problem with that Forex, the volatility in the Forex market, it can be happening 24 hours a day at different times. So you can see all of the volatility, for example, in the pound during the European Open session, or all the volatility in the yen or the Aussie dollar during the Asian Open market. So you have to be kind of available for when that volatility is going to take place. But the major reason why I don't trade Forex, and I don't like Forex for trading, is there is no volume information available, and volume is kind of key. It's certainly critical in the decision making process that I have trading the E-mini. Knowing when the professionals and amateurs are active is critical, and you can only tell that by looking at the average trade size, and then knowing whether a particular index or stock is being bought or sold on the bid and the ask is critical information, and a lot of that information is just simply not available for Forex. So that's one of the reasons why I stay away from Forex. Next market is commodities, and in commodities again you've got quite a large choice in terms of the different commodities you can trade. You could be a specialist and trade, for example, just gold or just crude oil, or you could trade a basket of commodities, but fair number of commodities in those baskets to trade, so quite a lot of decisions to be made there. In terms of information, again, there's kind of good information on the commodities, and certainly there's all the volume information, which is kind of critical for me, so that's kind of a winner there. However, the problem with commodities as I see it is it's not got the right kind of volatility. Commodities will spend quite a lot of time within a range and then suddenly kind of break out of a range, so you might have during the day not a great deal of volatility to be able to trade decent swings on a daily basis. And then there's also a problem of limit moves when it comes to commodities, and if you get stuck positioned incorrectly when you have a limit move either up or down in a commodity, that's a really serious situation. And for that reason I don't like trading commodities, because of those kind of possibility of having limit moves and the impact it'll have on your trading. Next market is the bond market. Again, kind of medium number of decisions here. You've got all the treasury markets that you can be trading in for the different countries, sovereign treasuries there, and you've got anywhere from 2, 5, 10, 30 years and so on in terms of the US markets. But then you also have all of the corporate bond market to trade as well. Good deal of information, very good information in terms of the bond market. However, the type of volatility you get in the bond market is not right for me. They tend to be very sleepy markets to trade, and there's not enough action as I see it in terms of day trading, certainly in the bond market. Swing trading, yes, more opportunities there, but in terms of day trading it's not kind of the right vehicle for me. Then lastly, the stock indices, and you can see here we've kind of given this a big green tick across each of the different criteria. First of all, in terms of minimizing decisions, effectively all you need to decide is the market going up or is the market going down? This is very simple in terms of decisions. Yes, there are different kind of stock market indices you can trade. You can trade the S&P 500, the Nasdaq, the Dow, the Russell, and so on, but those markets are highly correlated, so effectively you only really need to make one decision about which market to be trading there. In terms of information, very good information in terms of the price, volume, bid-ask data, average trade size, and so on. You also have a large number of other stock market information sources that you can use. There's the put-call ratio, find very helpful. There's also the TRIN and tick data, which is very useful. Then all kinds of valuation methodologies and so on. So large amount of information that you can use to make a decision. And then lastly, there's also good volatility. There's no limit moves, there's no kind of event risk. Anything that tends to be event driven tends to be smoothed out when you're looking at stock indices, and it's got the right kind of volatility from my perspective. So my conclusion is the stock indices is a good market to trade for those three reasons. However, there's a twist, and here's the last twist. And the twist is that you're going to have to park your capital, your trading capital, in a particular currency. Obviously, if you're trading the E-minis, the obvious decision there is to park your capital in US dollars. However, there are good currencies and there are bad currencies to have your capital parked in, and ultimately you probably need to make a decision about which currency to park your capital in. So although you might be trading, for example, the E-mini S&P 500 contracts, you probably ought to be looking at the Forex contracts as well in order to understand the differing strength of those underlying currencies and deciding where you need to park your trading capital. And then if you're watching this video on YouTube, check out the website Emini-Watch.com, and please feel free to comment or subscribe, give the video a thumbs up or favorite it. So good luck with your trading.